Institutional Investors' Embrace of Digital Assets. I'm Dan Barile. I'm a partner on the investment team here at Skybridge. I'm excited to be in beautiful Jackson at the second annual Wyoming Blockchain Symposium, moderating this discussion. Digital assets have moved from the periphery to the mainstream of global finance. Institutions, from asset managers to corporates, are no longer asking if they should get involved, but how. And today we'll explore what's driving this adoption and where the biggest opportunities and risks lie. And I have an awesome panel here today. So our panelists are Dan Morehead, the founder of Pantera Capital, literally the first institutional asset manager focused on the space, right? And any of you who know crypto and the story of Bitcoin know that Dan is like patient zero for Wall Street's involvement in Bitcoin. So fantastic panelists. We're very excited to have him on board. Sean Bill, Chief Investment Officer of Blockstream, global leader in Bitcoin and blockchain technology. Sean is doing some big things, and he's going to talk about that happening right now. Sebastian Coriciano, Head of Business Development at Galaxy Asset Management, one of the founding team members there. And Galaxy has really evolved into a full services financial institution, right, for crypto. And we do a lot of business with Galaxy in a lot of different ways at Skybridge. And so I think he's an excellent panelist here as well. And then Gregg Bell, Chief Business Officer at Hedera, which is leading the enterprise adoption of distributed ledger technology in areas like payments and tokenization. So I think Gregg will give us a slightly different perspective here as well. So I'm going to kick it off. This is an opening question for all, and we can just kind of go down the line, right? But we've all seen the headlines about growing institutional adoption of digital assets. And so I guess, like, Dan, we can start with you, right? Like, you have seen this from the very beginning, right? Like, what has changed over the past couple of years, right? But I mean, this has been 10 plus years for you now, right? Where you've been trying to raise institutional dollars in the space. How has it evolved? What's the big difference in the last year or two? And where are we going?
Great. Yeah, so I think the way that I visualize it is there used to be an incredibly long list of reasons to say no. There's no custodian, there's all this, and we've really crossed all of them off. And the last one was regulatory clarity, which was kind of a code word, but it really was just one agency in one country, right? Like all 200 other countries were pretty neutral on blockchain, and all the rest of the agencies in the US, like the IRS ruled on Bitcoin in 2013. It's been great. It was really just the SEC was making it very scary for entrepreneurs to build things in the US. And so I think the election last November is a massive unlock because it takes that regulatory uncertainty off the table. We've already gotten the stablecoin legislation done, working on the market structure legislation. And I think it's literally the last reason to say no to crypto is that old issue. And once that's off the table, I think institutions will come in greater force. And the point I love making is the median holding of cryptocurrencies and blockchain venture of the institutional investor out there is 0.0, right? The majority still have zero exposure to the space. Mm-hmm. So this hasn't even started. We got decades more.
All right.
Yeah, I would just add that I think, when BlackRock came in with the ETF, that gave a lot of air cover for a lot of the institutional investors. It's like the old saying, nobody gets fired for buying IBM, nobody gets fired for buying BlackRock, right? Mm-hmm. And so the ETF is finding its way into different pension funds' portfolios, and it kind of gets the conversation going. And so I think that with the election, those two things are just huge catalysts. And I'll pass it on to Sebastian.
I was in San Francisco earlier this year, and I'm at a Bay Area party. And if anyone has been to a Bay Area party, you'll notice two things. One is the tech bros have to do a better job of inviting the tech girls to the parties. But number two, get a bunch of like late 20s, early 30-year-old guys in a room. They're all going to shake each other's hands and be like, what are you up to? And saying you worked in crypto a year ago in San Francisco was like, I don't know, having like bad breath or something. People would just kind of walk away. And everybody was really focused on AI. And the real question is, why is that? And it's because everyone there was building something that they thought is going to be touched by millions of people. And crypto really just got that moment more recently, to be honest. I think Dan's been talking about crypto longer than I have been in the workforce. And if you really think about why, it's because we had to go through a number of cycles until we actually have applications and products that people can actually use every day, right? People are buying tokenized products. You know, I was just in Argentina, I think a country Dan also knows pretty well, from Peru originally. People are using stablecoins. And I think the reality is we were a lot more sizzle than steak for the majority of the time that I've been in crypto. And I think that's largely changing, right? Because we actually now have our own ChatGPT moments, which is probably an overused phrase, but people are actually touching, feeling, and this is making an impact in people's lives.
Yeah, I mean, institutional momentum is an interesting thing. Certainly, the guidance that the Trump administration has provided has undoubtedly changed the momentum. Second to that, I would say, is the success of the Bitcoin ETF. I think these two things, and certainly with Hedera, we're really excited about the two HBAR ETFs that have been filed for in the U.S. and the ETPs that are in Europe as well. But from an institutional perspective, real utility, the use of blockchain technology, and the use of Hedera to solve real problems, drive real revenues. Every time we're taking away, similar reason to Dan's conversation around removing those no's, it's removing risk. Removing the risk of onboarding, deploying technology is largely where we are today, and so there's a lot of excitement.
Cool. All right, so let's dive a little deeper. So Dan, I think you're in the middle of a big raise, right, for Fund 5, right,
Yep.
Venture Fund, right? So you're having a lot of institutional investor conversations now. So what, and you've been doing this forever, right? What do institutions still must misunderstand about the space, right? So you're having a conversation now with 2025, the environment is so much different, right? More supportive, and you're having a conversation with an institutional investor. Like, what are you still shocked that they think or say, and you have to try to, get them to get it, right?
Yeah, so I think the irony is there's this perception that blockchain is super scary and risky and all that. And the reality is literally the polar opposite. That we've been investing in venture companies for 13 years, and in the real world, 70% go broke, right? And a couple do okay, and one, helps your fund make, 1.7x on average. In our experience in blockchain, we've made money on 86% of the things we've invested in. And partly it's because our team's very good and we work really hard, but it's partly because we're in a great space, right? A rising tsunami is floating all boats. And I think that's the one thing institutions still just don't get is...
Like they're assuming a higher failure rate because this is a risky space.
Yeah, it sounds like a really risky space, but we make money on almost everything we invest in. And the multiples are just crazy. Our first fund's up over 1,000x net of fees and expenses, right?
1,000x.
Yeah, 1,000x. You have to have some exposure to this space. Anyone in the audience that still hasn't invested in this space, it has a 0.1 correlation with the S&P 500, and on average, Bitcoin has roughly doubled for 13 years every year. That is the dream asset to have in a portfolio. And so I think that's the one thing we're trying to help institutions. And the other one is, the IPO pipeline in kind of the normal world's been stuck for 4 or 5 years. So investors in private equity haven't gotten any capital back for a long time. Whereas in the blockchain space, everything happens so much faster. We've returned all of our venture funds capital within 4 years, and then typically multiples, within 5 or 6. And that just isn't happening in the kind of the normal private equity world. And so that's the other thing we're trying to help institutions see is that, we've been able to recycle $3 billion in cash back to people, 100,000 Bitcoins, and help them get, money to put into the next fund.
Great. Sean, so you've been staying busy. You've been working on a couple of really big things, and you've been making the rounds talking to institutional investors. So obviously the huge SPAC transaction with Cantor, if you maybe just update the audience on that and where you're at. And you've done some Blockstream's done some really creative things there, and talk about some of the institutional partnerships. And then I know you're making the rounds too for your hedge fund products, newer hedge fund products with hedge fund products created with Blockstream. So just talk about some of those conversations and what you're hearing from folks.
Yeah, so we started, Adam Back, partner, and I co-founded a company called the Bitcoin Standard Treasury Company. And we contributed 25,000 Bitcoin to kind of anchor it. And then we did the first in the US Bitcoin in kind equity pipe. And we raised another 5,021 Bitcoin there. And then we did the traditional SPAC route with Cantor. And then we did a convertible note, a little over 500 million there. We did a convertible preferred equity, a couple hundred million there. And then a common equity, like 400 or 500 million. So altogether, when you added it up with the SPAC, it was about another 1.7 billion in fiat. And then you add in the the Bitcoin in kind note, it was at 2.1 billion, which we thought was kind of fun. So we had another billion plus in subscriptions, but we kind of cut it there to try to hit the 2.1. And so that company really is, the idea behind it is, if you know Blockstream, Blockstream is a company that's a technology service provider to the Bitcoin ecosystem. And so we thought, well, let's create a company that will be kind of geared up towards being the Berkshire Hathaway of Bitcoin. And the idea being that we want to have an actively managed treasury. So rather than staying passive and static, we're going to actually put out the Bitcoin for yield. We're going to be investing it with other fund managers to try to get alpha return strategies. And then that's kind of what led us to our down the path with the hedge funds. And so back in 2019, when I was the CIO of the pension fund in Santa Clara, I actually had tried to get Bitcoin into the portfolio. And Dan is one of the 2 hedge funds that's been approved by our former consultant, for those portfolios, right? And that probably took years, I imagine, of going back and forth with these folks. But we were just trying to get off zero, right? That was our mission, was get something into the portfolio. And so we got 45 basis points into the portfolio back in 2021. It took about 18 months to do that. And so in 2022, I went to the State Association of California Retirement Systems to give a speech on how we did this, what were the mechanics behind it. And I think we had maybe 100 people that showed up for that out of like 600, 700 that were at the conference. We just went back this last May and did the same group, same audience. We had 600 plus, standing room only. We got 35 questions from the audience. So the sentiment has definitely shifted. I would say that with the institutional pension consultants, they're still not quite there yet, right? A lot of them are still pretty conservative. But I think with the positive, stuff coming out of Washington, the Bitcoin Strategic Reserve, the Texas State Strategic Reserve, et cetera, that we're going to see more of these red states start to get involved in the space more. I'm sure Pantera has picked up several clients in that area. And I think that, the climate is definitely kind of at that precipice where it seems to be tipping over. So I think it's going from a conversation of, don't have Bitcoin in the portfolio to why don't we have it? And I think people are getting there. You're aging out some of the older members of these pension boards, and younger members are coming in. They already own it. Half the firemen already own it. I was in El Paso 2 weeks ago, and the El Paso fire and police guy, came up to me. He's like, "Oh, half of our firefighters already own Bitcoin." So I think it is shifting.
Okay. Sebastian, what about from your perspective? So Galaxy, you can do business with Galaxy a lot of different ways, as I mentioned, full service financial institution. So, Skybridge has done business on the sales and trading side and lending and borrowing, and then we're an asset management client. What are you seeing today? What does that new client call look like? Like how has that evolved over the course of the last, 6 months, 12 months?
That's a good question. I think, if you were to just look at our quarterly filings, you're going to see AUM is going up, custody and staking is going up, right? New clients, AUM, notional value, trading volumes, counterparties. Look, it's all going great. We're in a bull market. I think the more interesting, to some degree, observation is we used to only have a handful of Skybridge-like clients who were, they're trading with the desk, they're getting borrows, some asset management things they're outsourcing to our business. And I think now we have dozens, if not, like 100 plus Skybridges. And by that, I mean, we built this institutional platform for folks to, choose your own adventure, if you will.
Yeah.
And, the number of clients that went from, I'm going to invest in a VC fund to, actually, I'm going to trade basis through you guys, or I'm going to, custody and stake my ETH, SOL, all the assets that we service there. That's really the cool thing, in my opinion. It's always easier to cross-sell a client than get somebody brand new, which we're doing both of them. But I think the more interesting thing is the number of, institutions like a Skybridge or other fund of funds or, other allocators in that world. They're not just stopping at the asset manager. I think they're getting people in certain seats. Maybe it's the cohort replacement concept that you mentioned earlier. But I think the uptake to interface with Galaxy in a multi-pronged variety, I think that's the biggest and most interesting thing. And candidly, that makes my job easier as business development, right? You just got to make phone calls from existing people, kind of connect the dots. So that's been, to me, probably the most striking thing. And vice versa, right? You got a, counterparty, general partner there. They're really focused on a systematic strategy, but they really want to understand or get better at extracting, crypto native or on-chain yield. Well, we have something for that too, right? So I think the ability to bear hug our clients in this multifaceted way, that's probably the most striking thing in the last 6 months, candidly.
All right, cool. Gregg, so tokenization is hot topic. So Hedera is clearly at the forefront here. So how are corporates and other institutions actually using Hedera today? What's the vision, right? How do you think it evolves from here?
Well, it's interesting listening to some of the asset managers that are over here, because the conversations that an institution has to go through to use Hedera or use a blockchain is very similar to the conversations that require for them to hold it on their balance sheet, right? They often have to hold those assets in order to have the gas to pay for various transactions. So, within Hedera also, it is a network that is validated and run by Fortune 500 companies. So there's Google and IBM and Nomura and Shinhan Bank and Mondelez, and they are not just validating transactions, but they have HBAR as a result of that validation. And so there's a need for the custody providers. There's a need for a lot of these different elements to ensure the ability to utilize the network. Now, within the Hedera Foundation, the 3 verticals that we've really been focusing on are the financial market tokenization. So it's ensuring that the applications are better off than existing products that exist. The second is around supply chain, and the third is on AI. So in the financial markets, we're seeing firms like Lloyd's Bank in Aberdeen. So Lloyd's in Aberdeen have a huge FX market that they trade back and forth on a daily basis. And so they're utilizing tokenized money market funds that are on Hedera by Aberdeen to intraday settle their exposure. And so by utilizing a system that is reducing counterparty risk, being more effective, they're actually able to find value to answer that question of why to tokenize. It's not just to have an asset that magically believe there's going to be liquidity. In the supply chain space, we have firms like Kia and Hyundai. So they are recording various elements of their supply chain on Hedera. So it provides greater integrity and information as it relates to their assets that are going through their supply chain. And then firms like PIXX and IO Finance that are providing the invoice financing and the factoring across supply chains. And then you have the AI level of how do we trust some of the data models and the compute. And so there are firms like Equity Labs that have collaborated with NVIDIA and Intel to embed Hedera hashing directly into the silicon of their chips so that they can validate the compute and validate the LLMs that are being run by Google AI and DeepSeek and OpenAI. And so addressing a trust problem, but utilizing these networks in a similar way. And so you have to have many of these service providers that were just described by some of the colleagues here. Cool.
All right, so we're going to mix it up a little bit. So I think this is a fun question. And it ties into, I think, some, if you are a traditional institutional investor, maybe some of your still lingering concerns about the space. So obviously the regulatory environment has changed dramatically, right, in ways that maybe couldn't even been imagined a year ago when we were at this event, right? And it's remarkable. And so these barriers are coming down so quickly. And there's all this creativity happening, which can be good and bad. So the question here for the whole group, and Dan, we can start with you, but as you look out a year or two, is there a chance that the new light touch regulatory environment gets too light and we end up, like, are we in danger of swinging too far in the other direction too quickly, right? And that's bad for the industry, right? Because now it is clear, you can even be a casual observer and you're like, wow, there's a lot of stuff happening right now that seems a little excessive. And we're creating an environment where that can continue to happen, right? So how do you think about that a year or two out, right? So there's some really important regulatory stuff that is, that things that will be firmed up, and this is all great for the industry, but does it go too far? What do you think?
I actually don't think so. I think that the way I think about it is the regulatory issues in the U.S. essentially held our industry back for 6 or 8 years, right? And so the kind of potential like euphoria you might be suggesting in the equity side of our business is really just a result of 8 years of things that have been stuck in the pipe coming out, right? And so, things like Circle, surged and MicroStrategy and all those things. But I think it's just a natural reaction to those things having been repressed for so long that they're surging up. But over the next, couple of years, like you said, there can be a bunch of companies go public and try and satiate all that demand. And that's, I think it's just a natural demand for this new asset class. And again, with the median institution having 0.0, it's not a bubble, right? There's so many people that have yet to get any exposure. And I do think these, digital asset treasury companies are a great example of how, there's just an incredible demand in the public markets to get exposure to this really dynamic space, to get these great returns. And, supply will meet demand at some point, over the next couple of years. But none of those are levered or, I just don't see what the risk is, and hey, in the real world, like banks blow up every 15 years, right?
Yeah.
Like all kinds of problems happen in the normal world, but I don't worry about it in crypto right now.
Yeah, I would say that, we looked at a transaction. We were looking at buying the guts of the Signet system, and we put a bid in on this company, and we were getting deep into it. And boy, I mean, like when you peel back the onion on this thing, and the banking system in terms of the pressure they put on these guys, they had moved over to Customers Bank, and then they got booted out of there a few weeks before the Biden administration left. And it was just clear, like, not only did they close the safe door and spin the lock, and then they just welded this thing shut, right? So it's like, I think you're gonna need a bit of time to unwind all this damage, right? And get this thing straightened out. So I was really stoked to hear the SEC chairman, saying, hey, we gotta go beyond the executive orders, and we gotta get it into legislation so that, it's kind of really in cement. So I think that's the way forward, and I think it's, to Dan's point, we're catching up here.
It's enabling compliant, DeFi to really take off, where there was the fear or inability to do so in the U.S. previously. And so that's, to me, really exciting. And to flip your question around a little bit, the harsh environment that we had, there is a plus there. And it's that those protocols that have proven themselves, that have been battle tested, can now be leveraged in a way by larger clients, by big institutions, by power users, in a way that they maybe wouldn't have before, because the proof is evident in the history of the protocol. And so you look at Hedera as an example, right? There's no sanctions risk. There's no validation that's going to occur because of the structure by a address or a node operator in North Korea or some other sanctioned wallet or address. There's no front running within the protocol because it's designed with a sequential transaction. So securities can be enabled like Swarm and Volfi to DeFi compliant DeFi protocols that are permissionless, but they can be done in a way that meets the regulatory standards of the securities market. And that's part of the benefit of having sort of a battle-tested environment.
Cool. Sebastian, any comment? Or?
Yeah, I think, look, there's a market structure bill. I actually think that's how that shakes out, and the jury's still out on that one, is probably going to be the best answer to your question, or the best crystal ball we have, and that's something we're following very closely at Galaxy. But if you look at the other piece of legislation that we were promised, which we've now, for the most part gotten, the Genius Act, it felt pretty straightforward, to be honest with you. Like, there's a permitting system, you have a clear oversight, stablecoin holders are super creditors. There's banks be remote frameworks, and collateral is going to be tightly regulated, and the number of securities that you can back these stablecoins with it's a very tight list, right? I take issue with the light touch piece because in my view that feels quite fair, right? There's a 10 billion, over 10 billion, under 10 billion, so you kind of have a lighter regulatory regime or sandbox for nascent projects. You don't over reward the incumbents. That feels pretty fair to me. The other observation I would make is, those safeguards feel a little bit better than a deposits and checking account at First Republic, to be honest. And I think the number of regional bank and credit union CEOs or employees here, they're probably here because they've taken notice of that fact. To be honest with you, it's in Argentina, if you walk around the street, a lot of people are circumventing holding a checking account because you have a direct access and direct ownership of your stable coins. I think, I don't know, that if you look at emerging markets, they're kind of, the customer base is speaking for itself about what they prefer, and we'll see how the market structure bill shakes out, but I'm not that worried yet. Things could get worse. The story of Icarus is kind of the story of crypto in some ways, and but I think the good part is the closer we get to TradFi, in some ways the tighter guardrails kind of exist, right? We're no longer in the digital wilderness, so to speak.
Great. All right, so we have a few minutes left. I'd love to bring the audience in here. If anybody has a question, please, pop up, pop your hand up, shout it out. All right, well, I see two in the front here. This gentleman here.
I really actually want to ask a question. Sebastian, you just mentioned about Argentina using stablecoins today, circumventing banking system in Argentina. Well, what if the government actually going to realize that there is no demand for their currency and going to look into banning using cryptocurrency, specifically in third world countries?
So that's a pretty good question. To some degree, it's like a forced dollarization of the economy, right? If you look at Ecuador, like that country already went through that process. Something like 30% of transactions in Peru, my native country, are actually, done using gray market dollar access. I just don't know how easy it is to stop, right? You already had enough trouble doing this with black market access to dollars or gray markets, however you want to frame it. In this case, you're not even looking for a physical dollar bill. Candidly, at this point, it'd be like trying to shut down internet access, which has a series of other costs to it. So, I think the right question might be, how inevitable is this? And I think it's very high. The better question you should ask yourself is, are you taking a form of sovereignty from a nation away from it? Maybe it deserves to lose it, candidly, with the mismanagement of Argentina. Peru went through its own, chaos in the 1980s. That's how I ended up here, right? My parents ended up migrating to the U.S. I think, it's going to be a question of do you deserve to lose that sovereign status, candidly?
So I have a little bit of a different take, and we have a number of different conversations with nation states around their central bank digital currency or other stablecoin use. And I wouldn't expect that there will be legislation within different countries that will require the settlement of some of their commerce within their either native currency or some stablecoin they're in. And so we've been seeing bank consortiums in the Philippines, as an example, that are coming with the Filipino peso tokenized on Hedera. We're part of Project Acacia, which is the Federal Reserve Bank of Australia. And so I think there will be a protectorate of the local economies within many nation states.
Dan, Sean, any comment? No. All right, please.
How has the rise of DATs affected institutional interest in our space?
Sean, you want to take that one?
Yeah, I mean, I think if you want to get if you are bullish, I mean, in our case, we only invest in Bitcoin. So we don't invest in any other alternative coins, or we're just pure Bitcoin. So I think the reason to look at something like ours is if you want to basically access leverage in terms of convertible notes and other instruments to get the common stock really, supercharge it. And I think that, MicroStrategy, of course, I think it's now like the 6th most active option in the S&P 500, which is, it has drawn a lot of attention in. And it's kind of crazy. Like you go to London and some of these other places, and last year, if you wanted to invest in Bitcoin, the easiest way to access it in your retirement account was actually buying MicroStrategy. So it's kind of not just a U.S. Thing; it's a kind of a global thing, I think. And we think it's that the trend is just getting started. So we think that it's very to Dan's point earlier about is it too late, is it too early? We think it's super early still. We're at $2 trillion market cap. A lot of people will compare it to digital gold, and that's $20 trillion. But if you go back to like Hal Finney's early predictions, you can look at this as a $100 trillion plus market. I'm just talking just Bitcoin here. So we think it's super early still. It's these treasuries are a great way to help other investors accelerate their accumulation of Bitcoin.
All right, so we're about up on time, but we'll go down the line, and any closing comments you want to make, Gregg, we'll start with you. And then this is where the last thing standing between the cowboy cookout. So we'll wrap up in the next few minutes. So.
I think the intersection between AI and blockchain and the speed at which AI will begin to be the largest center for transaction volumes on networks is going to happen far faster than people think. And a lot of time meeting with projects and meeting with companies that are building in the space, it's about bringing on that next trillion transactions. Those are device to device. Those are AI agent driven. And they're not going to be through legacy rails.
The thing we're most focused on here is stablecoin adoption. We have an entire venture fund that's, the primary thesis surrounds, giving folks USD sort of back stablecoin access for saving, spending, and sending in a more stable currency. So from my view, that to me is going to be the gateway drug, if you will, for the rest of tokenization, how to expand and get U.S. securities into a broader hands across the world, and probably build a more inclusive or global capital markets, personally.
Yeah, I think like with the new administration and the new regulatory environment, that you're going to see a big takeoff in tokenization. We've seen it on our layer 2 technology. We have a protocol called Liquid that's built on the Bitcoin ecosystem. And I think a year ago we had 1.5 billion on there, and now it's over 4 billion. And we don't promote it, we don't market it. It's just growing on its own. And it's got everything from like Mexican small business loans to actually like MicroStrategy. So I could say, hey Dan, I owe you $20 for lunch. I'll pay you. Do you want it in MicroStrategy, or do you want it in Bitcoin or
cool.
dollars? And I could flip it to you on Liquid. So it's pretty cool.
Yeah, I would say if you haven't addressed cryptocurrencies, you really should. I've been doing this for 13 years, and so many people have been so skeptical, and all these, kind of very, very, very shallow reasons to be dismissive of it. But if someone actually spends a couple of days reading about it, the virality rate is like 99%. Like when someone actually does the work, and this is my favorite example, is there are a bunch of Warren Buffett type people that do these, it's rat poison kind of lines. I've been asking for this for 13 years, never found it. A multi-page paper that's negative on crypto. There's no intelligent person that's ever sat down and written a multi-page paper that's negative. And even a lot of the haters now, there's a lot of famous Wall Street people that used to be haters that are now selling Bitcoins to their customers, And so if you're negative, if you are stuck on it, just spend the time, read a couple papers, and 99% of people go, oh man, I got to buy some of that.
All right, beautiful way to close it out. So Dan, Sean, Sebastian, Gregg, thank you guys so much. Cowboy Cookout starts at 6 p.m., Snake River Ranch. So we hope you guys all go there. There's going to be shuttles from the front of the hotel. It's going to be a great thing going on for, I think, 3-4 hours, something like that. Live music, food. So please join us if you can. And thanks, everybody, for being here in Jackson. So thank you so much.
Thank you.